All right, welcome to our budget special. Today, we're going to cut through all the jargon and tell you exactly what the 2025 budget means for you, for your wallet, and for your business. So, let's just dive right in.
So here's a weird question to kick things off. What was in this budget before the Chancellor even stood up to speak? I mean, this year's whole announcement had a very, very strange start, with some of the biggest details getting out early. How on earth did that happen?
Well, it turns out the Office for Budget Responsibility, the OBR, had a bit of an oops moment and published its report ahead of schedule. But while a leak is always juicy news, what really matters is the substance, right? What was actually in that report? That's what we're going to focus on, the policies themselves and the real-world impact they're about to have.
Okay, first up, let's talk about the changes that are probably going to hit closest to home for a lot of you. The new taxes on property and on your savings.
So, take a look at this. Starting in April 2027, the government is bringing in new, separate income tax rates just for property income, and it's raising the rates for both property and savings. The big takeaway? It's simple, really. A flat 2 percentage point hike across the board. It doesn't matter where you fall, basic, higher, or additional rate, it's going up by 2 points. So, who's going to feel the pinch the most from this? Well, landlords in England and Northern Ireland are right in the firing line. So is anyone with a decent amount of savings income. Then there's this new council tax surcharge for properties worth over £2 million. It's basically a mansion tax that's going to cost owners an extra $2.5 to $7.5 grand a year. And it doesn't stop there. Company shareholders are also going to see dividend tax rates go up. It's pretty clear they're looking to raise more money from assets and investments, not just from what you earn in your day job.
Okay, so that's the personal side of things. Now let's pivot and look at what this means for your business. Because, well, there are some pretty big new costs coming down the pipeline that every single employer needs to be ready for. Starting April 2026, the national minimum wage is going up for everyone. The main rate for workers 21 and over is climbing to £12.71. But here's where you really need to pay attention. Look at the jump for younger workers and for apprentices. Those increases are even bigger, and that means a direct, unavoidable rise in your payroll costs.
And if you look at it in percentage terms, it's even clearer. A 4.1% rise for the main rate is one thing, but an 8.5% jump for 18 to 20-year-olds, wow. And this isn't just a random number pluck. It's all part of a bigger government plan to eventually have a single minimum wage for all workers, no matter their age. That's something businesses absolutely have to factor into their financial plans for the future.
Now, before we get into the nitty-gritty of what's changing, let's just do a quick refresh on capital allowances. What are they? In simple terms, it's a way for your business to subtract the cost of big-ticket items, like new equipment or company vans, from your profits before you pay tax. It's a really important tool for lowering your overall tax bill.
So, what's changing here? Well, it's a bit of a mixed bag, a real give-and-take situation. The good news, the annual investment allowance is staying put at a very generous £1 million. And if you're thinking of going green, the 100% relief for electric vehicles has been extended out to 2027. But, on the other hand, the writing down allowance rate is being cut from 18% down to 14%. That just means you'll be claiming tax relief on some assets a lot more slowly. To try and balance that out, there's a new 40% first-year allowance coming in January 2026, which should offer a nice upfront deduction for certain investments. All right, so let's pull back from the immediate stuff and look at the long game. Because this budget wasn't just about next year. It was setting the stage for some major shifts that you're going to need to start planning for now. This timeline is your roadmap of what's coming. So, get your calendars out. 2026 is a huge year. That's when those inheritance tax reforms kick in and the new capital allowance rules start. Then, looking a bit farther down the road to 2029, we'll see a new cap on salary sacrifice schemes and a complete mandatory switch to e-invoicing for VAT. Let's drill down on what's probably one of the biggest long-term changes here, inheritance tax. Right now, it's pretty straightforward. Qualifying business and farm property can get 100% relief. But from April 2026, that's changing in a big way. That 100% relief is going to be capped at £1 million. Anything over that 1 million mark will only get 50% relief. There is a little bit of a silver lining, though. Any part of that £1 million cap that you don't use can be transferred over to a spouse. Okay, let's zoom out one more time. No budget happens in a bubble, right? To really get the full picture, we need to look at what else is going on in the wider world of business and regulation. So here's a quick briefing on some other key things you need to have on your radar.
First up, a number from the latest Health and Safety Executive Report, 1.9 million. That's the estimated number of workers who suffered from a work-related illness just in the last year.
And if we break that number down, it gets even more concerning. Almost half of those cases, a staggering 964,000, were workers reporting stress, depression, or anxiety that was either caused or made worse by their job. That's a massive and growing problem.
So what does all that mean in real terms? What's the cost? How about 40.1 million? That's the number of working days lost in the last year because of ill health and injury. That's not just a personal tragedy for individuals, it's a huge drain on our national productivity.
And finally, just to round things out, a quick run-through of some other headlines. The Competition and Markets Authority is launching a big study into private dental care. If you're a commuter, there's some good news. Regulated rail fares in England are being frozen until March 2027. And for the self-employed, HMRC has finally fixed an annoying error that was wrongly charging some people for Class 2 national insurance.
So, to bring it all back to the budget, this quote really sums up the whole thing, doesn't it? There was a lot of talk about growth, but the reality is that with higher taxes on savings, on property, and on dividends, pretty much everyone is being asked to chip in a little bit more.
Which really just leaves us with one final crucial question. With tax hikes on the way, new rules to follow, and rising costs to manage, planning ahead has never been more important. So the real question I want to leave you with is this: is your financial plan ready for what's coming next?